Welcome to our deep dive into the crypto clarity era, a strategic analysis of the profound U.S. digital asset regulatory transformation anticipated between 2025 and 2026. This period marks a pivotal shift from fragmented, enforcement-driven regulation to a robust, statutory architecture. We'll explore how this foundational change reshapes the landscape for digital assets, providing much-needed certainty and opening new avenues for innovation and growth within the United States. This era represents a true paradigm shift, catalyzed by Executive Order 14233 and the rescission of SAB 121. We're observing a move from reactive enforcement to a proactive statutory framework. This transformation is projected to unlock significant institutional capital, estimated at over $2 trillion within 5 years, while dramatically reducing regulatory uncertainty. We also anticipate the formal recognition of 3 new regulated asset classes: commodities, securities, and ancillary utilities, all underpinned by key legislative pillars. At the heart of this transformation are 2 critical legislative pillars: the Genius Act and the Clarity Act. The Genius Act focuses on institutionalizing the digital dollar through payment stablecoins, establishing a framework for permitted payment stablecoin issuers with strict 1:1 asset backing. In contrast, the Clarity Act is designed to reconfigure market jurisdiction for broader digital assets, delineating regulatory oversight between the SEC and CFTC, and introducing a novel factual maturity certification for decentralization. The private sector systemically important payment systems for digital dollars are structured around a crucial 3-tiered architecture. Tier 1 includes insured depository subsidiaries that integrate stablecoins directly into our banking framework. Tier 2 comprises federally qualified non-bank issuers, often referred to as narrow banks, operating under unified federal oversight. Finally, Tier 3 covers state-qualified issuers with a vital provision: any issuer exceeding $10 billion in consolidated issuance must transition to federal oversight, ensuring robust national supervision. The Genius Act imposes a stringent high-quality liquid asset mandate for stablecoin reserves. This means 100% backing in cash and short-term U.S. Treasuries, ensuring robust stability. Monthly public disclosures enhance transparency, while minimum issuer capital requirements bolster operational resilience. Critically, these stablecoins are prohibited from yielding interest, preventing disintermediation of traditional bank deposits, and holders receive priority in insolvency, providing direct consumer protection against potential failures. The Clarity Act fundamentally reconfigures market jurisdiction for digital assets. An asset is first evaluated against a decentralization threshold. If it meets factual maturity, it becomes a digital commodity regulated by the CFTC. If centralized control remains, it's categorized as a digital security under SEC oversight. A special carve-out exists for ancillary utility tokens, which are exempt from standard securities registration if used exclusively for platform access, fostering innovation in early-stage networks. The regulatory transformation unfolds across several phases, beginning with enactment and a registration window, followed by decentralization audits, and then disclosure enforcement, leading to overall market stabilization. This structured approach is expected to drive substantial institutional capital inflow, projected to grow significantly over the next few years. While new compliance requirements will increase operational costs across legal, infrastructure, and registration fees, the overall framework aims to create a more predictable and secure environment. The OCC's 83-day sprint was ignited by an amendment expanding fiduciary activities to authorize non-fiduciary custody, removing legal ambiguity that previously barred banks from holding private keys. This opened the door for a surge of national trust bank charter applications from December 2025 to March 2026. However, This initiative faced significant pushback from traditional banking groups due to concerns about an uneven playing field, particularly regarding the lack of Community Reinvestment Act and FDIC requirements for these new entrants. A key geopolitical strategy involves establishing a strategic Bitcoin reserve capitalized through forfeitures, making the U.S. the largest state holder globally, with a mandate to avoid selling these assets. Alongside this, the U.S. Treasury manages a diverse digital asset stockpile composed of various cryptocurrencies, which are liquidated to satisfy penalties or compensate victims. This dual approach serves as a de-dollarization counter-strategy, transforming an anti-dollar instrument into a sovereign reserve to hedge against global economic shifts. This analysis highlights the relationship between regulatory compliance burden and projected market liquidity for different digital asset classes. Stablecoins stand out by optimizing systemic liquidity with manageable compliance friction, underscoring their efficiency and broad acceptance. Digital commodities also show high liquidity with a relatively low compliance burden. In contrast, digital securities face the maximum operational burden under SEC disclosure rules, which translates to declining liquidity as regulatory requirements increase, impacting their market viability. The Clarity Act faced significant challenges, ultimately freezing its progress in early 2026. This stagnation was largely due to an executive ultimatum from the Trump administration, linking its passage to other legislative priorities, severely reducing its odds. Furthermore, industry fragmentation played a role, with key players withdrawing support over issues such as the prohibition of stablecoin rewards and concerns regarding expansive anti-money laundering provisions that could impact decentralized software development. The Genius Act impacts key macroeconomic variables, putting downward pressure on T-bill yields, easing deficit funding by creating a sticky buyer for the national debt, and potentially stagnating bank deposits as narrow banks compete. The Federal Reserve remains cautious about granting payment accounts to issuers, fearing disintermediation. A critical risk is the Treasury redemption spiral, where a run on a major stablecoin could force the rapid liquidation of T-bills, spike yields, and potentially lead to contagion across traditional financial institutions. Looking ahead, we envision a future driven by agentic commerce, characterized by autonomous AI-to-AI transactions. Traditional financial systems pose numerous obstacles to this evolution, owing to their legacy infrastructure and inherent inefficiencies. The advent of regulated stablecoins, however, offers a native currency approach, providing the fast, automated, and secure financial rails essential for these intelligent agents to execute the next generation of global commerce efficiently, bypassing legacy system limitations. The U.S. excels in stablecoin integration and sovereign asset stockpiling, but is vulnerable to broader market structure challenges due to partisan politics and friction around decentralized finance. Meanwhile, the European Union's MiCA framework is fully operational, setting a competing global standard. Europe benefits from clear legal sandboxes for tokenized real-world assets, albeit with stricter limits on stablecoin banking, and offers more expansive options for non-dollar assets. This global regulatory competition will dictate where next-generation digital asset enterprises choose to establish residency and allocate capital. First, stablecoins are now sovereign infrastructures. The Genius Act successfully bridged blockchain and the U.S. Treasury, creating a multi-hundred-billion-dollar mechanism for deficit funding. Second, the convergence of traditional finance and crypto is irreversible. The OCC's sprint showed major institutions seeking federal charters, signaling the end of crypto as a fringe ecosystem. Finally, the AI imperative highlights that the ultimate geopolitical advantage lies in optimizing financial rails for the autonomous AI agents that will execute future global commerce, not solely protecting human investors from volatility.